Welcome traders, this is Chris Buss with Traders Profit Compass. This is the companion video to the Weekend Profit Navigator for September 13th, 2020. I want to start out with something a little bit different than what I've done in the past, and that's with a trading psychology segment. And the title for this weekend's Navigator is Respect the Regime Change. And that was brought about by a trader in our mentorship group this week that was talking about his difficulty both recognizing a market shift and then once recognized, taking advantage or participating in that change. And as we were talking about it, I made a couple points to him. One, traders are creatures of habit. They do things repeatedly that have proven to work. One other thing that is unique to traders is that their brains remember when they made the most money. I'll give you an example. I was listening to an interview with Stan Druckenmiller, the famous investor, probably one of the best ever. He famously, along with George Soros, had shorted the British pound and made billions and billions. He nailed the dot-com bubble and made a bunch more millions, and he did billions. And he did quite well in the great financial crisis. And although he doesn't regard himself as some big short seller, over his career he has made the most money on the short side. And in the interview he was talking about how in the period between 2010 and now, that he had really not participated to the degree he thought he should have on the upside, because his biases and everything that he knew told him the rally coming out of the great financial crisis was fake. And he didn't put any stock in the Fed's ability to create a sustainable rally with all the QE and stuff like that. And he said the fact that he had made a lot of money on the downside affected those thought processes. And the same goes for us. I think any of us that have been trading for a while remember those stocks and those trades and those times that have done the best for us. Whether they be on the long side or the short side, it's just human nature. We remember that feeling of success, whether it be, buying Apple low and having it run up, or Tesla or any of these other stocks that just have gone crazy and made you a phenomenal amount of money. Well done. But that's burned into your head now, that those stocks only go up. At least you have a bias in that direction. Anybody that has bought the dip since March 23rd of this year has been right in a big way. It's been the right trade to buy every red candle and just watch it go up. So there's a built-in bias, especially with the new trader community, the Robin Hooders and those people that are new to the markets that haven't experienced a downside move. So I went and found a couple of quotes that I think are informative that I'd like to share with you. Stiffness is the companion of death. Flexibility, a companion of life. It's not the change that is painful, it's only your resistance to it that's painful. And I think these quotes these universal truths, because these have been around for 2,500 years as applied to life in general. But I think they hold significant power over our trading lives as well, because if you are stiff in your thinking, if you're locked onto a narrative, and the reality on the ground changes, but you resist that change, that's going to be very expensive and it's going to be very painful. For traders to be successful, they need to be flexible and fluid in their thinking, recognize the change, and be fully willing to embrace that change when it occurs. And if we maintain that flexible, fluid posture, we can take advantage of both a bull market and a bear market and participate on each side of the trade. A metaphor I like to use with the people that I work with and our trading group in general is, imagine yourself as a leaf floating on a stream, and that leaf is price, and you're sitting on top of that leaf. When a leaf goes down a stream, it doesn't really care if it goes left or right, if it goes fast or slow. It just goes with the flow and is more than happy to bounce along, the ebbs and flows, the left and rights, the fast and slow. Wherever that stream leads, that leaf is happy to go right along with it. I want you to be a leaf on the stream of price. More than happy to be in a bull market, more than happy to be in a bear market, to position yourself accordingly if evidence presents itself to one or the other. And if there's a moment or a period of transition, to recognize that as well. We've had quite a number of V-market, plunges and recoveries. We really haven't seen, the bear markets have been steep and fast, with a V recovery coming out of that. That may not always be the case. Just because it's happened recently doesn't mean it's going to happen the next time. So, stay fluid, stay flexible, don't resist that change, embrace it, and I think everything's going to turn out just fine in the way it should be. So let's see what we can find in the charts. I want to start on the weekly. Here's a SPY weekly chart. We came out of the March low. We took out the February high. And now we've pulled that back for 2 weeks, basically sitting on that ledge there of the February high. One of the tenets in technical analysis is once you break out, back tests are normal and to be expected. So we've got that, breakout and the back test. But if you break back into the prior range, number one, that shouldn't happen. We've got all these people here that have bought at any point. Once you got to here, everybody was profitable. We took out the old high. So there's no natural sellers up here. But now we've come back to test it. If we were to come back in to this prior trading range, that's a bearish technical event, and it needs to be accounted for and recognized that we should not lose that prior high. With all this support below, that should just not happen. And if it does, we need to recognize that and be aware of it and ready for it. Also, I've penciled in the fibs off of the March low up to the high, showing the 38%, the 50%, and the 618 retracement levels. These are very common levels to check back to before the trend resumes. So a pullback to 305 or the 40-week EMA here in green to 310, that's still a bull market. That's still a bull trend. Even a half back, a 50% pullback here to 287. I mean, you'd have people jumping out of windows if we came back to 287 quickly. But that's a common pullback. And that's not out of the realm of possibility. So I want you to keep these fib levels in this 40-week EMA kind of, they don't have to be front and center, but recognize that a pullback down to these levels would be perfectly normal, and this bull trend would still be intact if that were to happen. Moving on to the daily chart, we had this nice channel coming off the lows. That channel has broken, and now we're sitting right, for all intents and purposes, on the 50 EMA with price pinched below the fast EMAs, the 8 EMA here and the 20. Price is between those two and pressing on the 50. We can see that RSI had been above 50 the whole time, but now it's not. That's a change. PPO is still above its signal line, still above its zero line, but has put in a bear cross. We can see that there. This week, they either hold the 50 or they don't. It's just that simple. If they hold the 50, the bulls can claim victory, or at least put off any ultra bad consequences. But if they lose the 50, this 331.79 level, I see price coming down here to 320 relatively quickly. And then that will be the next area of support where price, will have another, decision point. And then if that level were to break, we'd be back at the 200 down around 310, which aligns really well with the fibs off of the on the weekly chart. So all eyes on the 50. They basically parked right on it on Friday to keep us guessing. So both the bulls and the bears are still in the game, just the way they want it to be, guessing over the weekend. But here's the thing. Look at the size of these bars. Look at how they dwarf the size of all these bars all the way down until you get into this June area. That's a change. Volatility has expanded. It's not these little micro moves grinding on the way up. Volatility has expanded. We're on a sell signal on the break of this channel. That's a change. Don't ignore it. Recognize it. If you've been long this whole time, I think you got to cool your jets here and see how this resolves. The dipsters are going to try and save it because the dipsters have been winning the whole time. This might be the time where they don't. And that's all I'm saying. Don't continue to think it's going to work just because it always has. There will be that day when it doesn't work. And if you've got embedded gains from all this action. Don't let it slip away. If the 50 breaks and then it comes down here, you're just letting money bleed out for no reason. Recognize the change. Lighten up your portfolio if you're, really long, and be mentally ready if this breakdown happens. That's all I'm saying. Here on the 30-minute chart for active traders, we've got price moving into this bullish falling wedge, and we've got bullish divergence here on the PPO. And usually that's a recipe for a breakout. When you're making lower lows in price, but momentum is rising. But here's the thing, guys. I can show you 50 examples of bearish setups back in the period of, between March and just recently. Lots of bearish setups that never played out. And that's what happens. That's a tip-off to know you're in a bull market. When bearish setups fail. When breakdowns occur, but there's no follow-through. What I'm wondering, and what I'll be watching closely this week, does this bullish setup work or not work? If it doesn't work, if we take a move down to fill these lower gaps down to 330 and down to 326, down to 325, that will be a big tell that things are really changing. Now, if price breaks out tomorrow and makes some impulsive move higher, then the downside theory has to take a pause, because you've got to respect price. And if it breaks out of this falling wedge and makes some higher lows and takes out this high here, maybe it was just a 2-week sell-off, and the dipsters will again prevail. Don't forget, we've got the Fed this week too, and they're going to be out pumping. I don't think we can assume that they're going to sit idly by while the market sells off. So we'll just have to see about that. I can't trade the Fed. I think it's almost impossible to know what they're going to do or what the reaction will be. But I will be watching this 30-minute trend line and this wedge very carefully tomorrow, and to see which way it breaks, and I think that'll be a tell. Qs, we know that this sell-off has been focused on large cap tech. We see we came off the lows, we took out that February high, and have been on a massive run since then. Really uncorrected off the lows, way up here, overextended. We've had a 10% pullback from 305 to 270. But look where the fibs are. Fibs, the first potential reaction area would be down at 250, and the second level here at a 50% or half back check back is down at 235, and that lines up well with the 2020 high. And remember, on the SPY chart, we've already tested the SPY 2020 high. So as far as the Qs go, there's still a lot of air in the balloon that I think has the potential of still coming out. And we've got a little support here at 265, but honestly not a lot. I think there's a really good chance that in the weeks ahead, maybe this week, maybe the next few weeks, we come down here for a test of 250 and quite likely down to this 235 level. And if we were to lose the 40-week moving average, that would be quite bearish, dropping below the 2020 high. But look over here in the volume over price profile. There is not a lot of technical support there, compared to here where we've had all that two-way trading. We just haven't had it up in this area. And as a consequence of that, there's quite a bit of lack of support for this move. And as we'll discuss later on, there's not a lot of short interest either. So there's not that natural buying to cover that can arrest a sharp sell-off, because there's not a lot of people that own puts that would want to, buy and cover there. So there has the potential to be a fast move here. Looking at the daily chart, we see that volatility has expanded. We see RSI dropping down below into its bearish regime. We see a significant bear cross in the PPO, and we see price dropping out of a long uptrend channel and sitting on the 50. If nothing else, you'd have to conclude something has changed. And when something changes, that means your mentality has to change. You can't be blindly long. You have to open up to the possibility of a downside move. And if you've been following along the last couple of weeks, there are a lot of algos and fund managers that key off holding the 50. The momentum oriented funds and algos, by mandate, if price starts trading below the 50, they have to sell, because the momentum will have been broken. So be on the lookout. If there's a break of the 50, I expect there to be a flush move, a scary flush move, if that happens, because of the algos kicking in and the forced selling from the fund managers, and also with margin calls, especially on the high flyers that are pulling back. There's a lot of traders out there that don't even know what a margin call is, because they've never faced one before. So that would be a place where a lot of weak hands would get out of whatever they're trading, and where fund managers would go into forced selling. Here on the 30-minute chart, we see the same bullish falling wedge. If price were to break above 272 and take out this 275 level with the bullish divergence, that would be something to recognize as a trader, that the bulls have been able to force a change on the short time frames, and we may get a rally above 275. We could see as high as 280, 282. But to really put in a convincing rally that you'd want to buy, they got to take out this breakdown candle high right here at 286. In my mind, they've got to clear this to have a clear shot at going up back towards the highs. If price breaks out here and then stalls or rolls over, or at 280 where it found a problem before, then I think it would be a false breakout. IWM's a totally different animal. It never got to the February highs. It's never taken out its 2018 highs. So it made this move up to 157. We've been thrashing around that 155, 157 area, and now we've pulled back away. So I'd be watching this weekly PPO, watching for a cross. I think this is going to come down and test this 40-week moving average down around 145. Here's the daily chart. We had this $5 trading range for about a month, 3 or 4 weeks. Now we've dropped below, and prices pinched between the 50 and the 200. I think what you're going to see is price move down to this 145 and then wrestle with the 200. And if SPY and QQQ are weak, I would expect this gap to fill down to 142 and then find support at this big volume over price bar at 140. And that might be a place to buy a dip at this big volume over price bar. I would call that key support, but there's going to be some time that passes between now and then, and I'd have to see some other stuff first before pulling that trigger. If we go down to the 30-minute chart, same deal, bullish falling wedge, bullish divergence. I think this is just a kickback to back test this breakdown. I would be thinking this would fail right here between 150 and 150 and a half. If price can prove that I'm wrong with the breakout, then so be it. Then it's got room to come up here to 152, 153 and a half, and potentially 155. And I think that's the key for these stocks that have faltered. The onus is on the bulls now, whereas before the onus was on the bears to prove that they could break it down, and they never could between late March and until just recently. The bears have the ball, so the bulls have to be the ones to recapture it, retake control, and the bulls have to prove it with price. Now I just wanted to show you some key industry groups. Here's the Internet Index, the daily chart, trend break, sell signal, price below the 50, below the 8, below the 20, it's below everything, with the 200 way down here and the prior high down here at 2150. Fibs don't come into play until down here. I think there's room to fall on the internet stocks. This is the software group. RSI has dropped below 50 and dropped below trend. Bearish PPO cross. Price has violated its uptrend line. Below the 50, below the 20. Again, with the February high way down here at 35.95. It's still got quite a ways it could fall before finding some support. So be careful in your software names, because they have had an extended run, like the internet stocks and some of these other ones. This is the semiconductor group, which has actually been kind of resilient lately, but again, broken up trend line, trading right at the 50 with room to fall down to the 2020 high. You can see RSI has dropped below 50. Still certainly savable, but it is on a sell signal. And if you look at it, I could easily draw in this impulsive move lower, consolidating in a flat flag, and then projecting a measured move down towards this 4,700. So again, this is another risk on, risk off type sector. Even if you're not trading it, you can watch it to see, what's happening, where the sentiment is going. Biotechs, they've been on a sell signal for a while. They've established, a clear downtrend. Here we've got RSI in the bearish regime. Here we've even got PPO below the zero line, which puts it in bear territory. Making a test of the 200 right now. You may get a kickback here to this 130. But if you did see that, that would be a great location for a short with a tight stop against overhead resistance and the downtrend line. I think it's going to be coming down here into the low 120s, down to this lower channel line again. Everybody's talking about the banks. Big triangle broke below last week with RSI breaking below the 50 and momentum rolling over. Yeah, so certainly no bull signals there in financials. Retail, pretty much the same story. We've got RSI breaking below 50, putting it in its bear regime. We've got PPO rolling over, putting in a bear cross. And we've got price breaking trend, getting itself on a sell signal, and coming down to test the 50. And you'll see in a lot of charts in your own holdings, the same things that you're tracking, that you'll find a lot of stuff right around the 50 EMA. And that's what makes it such a key level, because it's lost the 8 and the 20 for the momentum trade. Now it's trading below. And once you lose the 50, if you do, then all those moving averages that turn down act as resistance on any bullish move. And then you start putting in lower highs and lower lows, starting a pullback downtrend. You can see the fibs here in brown. You can see the prior high back here at 45.50. We had actually gotten long in here and we wrote a lot of this up here and had some nice trades, and then took it off near the highs on this bad day. The first bad day, we got out of that, and it's proceeded lower since then. I want to go through FAANG real quick. Facebook's been holding up the best. You can see it's in this rising wedge, and price still above trend and still above its 50. Here's where I think the dipsters, if they're going to show up, are going to show up right now. We do have a trendline violation on RSI. We do have a bearish PPO cross, but we are at both lateral and trendline support. So if the bulls are going to step in, this is where I would do it. And if I was bullish and I think this is a buy the dip moment, you got to buy it right here. If that's you, you can go long and then set your stop just below the 50. And if it doesn't hold, you're out with a relative paper cut. And then I think you'd be forced to be bearish. If it lost this critical trend line, lost lateral support, and then lost the 50, you're coming back, and there's a big gap down here between, like 247 and 235. That would probably fill, over the days and weeks ahead. And depending on what happens in the whole market, you've got a 200 EMA test down here, which would fulfill a back test of the original breakout here at 221. Apple, I said before in the last couple of weeks, I think there's a lot of trapped longs up here that bought the split, that were involved in this massive run up, that bought that split, and now we had the initial breakdown, the initial tag of the 50. We got a back test of both the trend line and these fast moving averages, and it was rejected. And now we're at this critical level at 110, and it may be hard to see here, but we've only got 1 day of price action between 108 and 96. And I think if you see 108 fail, I think it's going to go fast. I think it's going to go real fast, because there's literally no support under this until it gets down in the high 90s, the mid 90s, and I think that's where it's heading. If you were to get a kickback rally up to 120, that would be a great place to anchor a short. I think that all these people will take any material bounce to sell, because I think they recognize that they made a mistake right here. So I would short any kickback rally to 120. Otherwise, I would get short on a break of 110 at the 50 and use that as your anchor point with a stop just above. And I think there's a real good chance we come into the mid 90s. Amazon closed below the 50 and broke its uptrend, so it's on a sell signal. RSI is below 50 for the first time in the longest while, all the way back to the March lows. So again, that's a change. That's a change that you need to recognize and be aware of and respect. It's broken trend and closed below the 50. So the first move I would expect is down to 3,000 to test this level. Now, even if you've never traded Amazon and you see Amazon break 3,000, look at this void. Almost no trades down in here. I think you would see a 200 EMA test down here at 25.50. That would be a nice trade if you were to get short against 3,000 and then it really accelerated to the downside into this void. Then you'd have a real trade on your hands. I really like that trade. As it stands now, I think you can be short against the 50 and look for a move to 3,000, which is, what is that? $116 away. But that's not the real move. The real move is from 3,000 down to 2,500, 2,550. Microsoft has been very weak. You can see it was in this rising wedge. It broke. It came down, sliced right through the 50, had a kickback rally that was capped by the declining 8 and 20 EMAs. And now it's testing this 202.50 level, which is a nice level of support. If it were to break there, I think you're going to come down and into the mid 190s and eventually back test this original breakout level, and I think you're going to see a lot of dipsters try to buy that right there, and that would be a logical place to buy on a back test of the original breakout. I think that would be a very objective place to try and get long against 190 if the market is, starting to look somewhat constructive. Google, same thing, break below 50 on RSI, bearish PPO cross, coming out of a divergent high where momentum was higher back here than it is here at the high, and that's a a recipe for a pullback, and we got it from 1725. We're $200 lower, and what's more important is we're below the 50. So I think until this trend line were to be recaptured, I think you've got to lean bearish on Google. And if you got a break of this 1475, I think you're going to come down here for a test of the 200. Netflix, there's been several people trading this well in the group. Really looks like a double top here around 560. It has come back to test this support level at 480. Notice the void under 480. I think if that broke, you'd be coming down here for a test of the 200 at 420, and that would be a 50% pullback off of the highs, from the March low to the highs. And I think that all aligns really well together with the 200, this big volume over price support bar, and the fibs. So I think on a break of 480, you could get short with a stop just above and look for that move, $60 lower. Tesla has actually, despite the big pullback, has held it together. We've got a nice trend line off of the March lows, and prices holding above both trend and the 50. Again, if the Tesla bulls are out there, they need and should be buying it right here against trend, and maybe they can pop it up to new highs if this is a buy the dip moment. But if you see that this trend line breaks and the 50 breaks below it, then we're coming back to this 280 level for a check right here, and then after that, possibly lower. But right now the bulls still have the ball, and if the Qs and the SPY firm up and the bulls step in here, that'll prove to be a buy the dip moment. I think there's more to come out of it. Not to be wishy-washy, I think this will ultimately break and trap all the people that bought the split. I think any kind of baby bounce will be sold into by all these people that recognize they may have made a mistake. And that will be especially true if the Qs back off. Last chart. This is I call it the extremometer. And it's a little busy, but I'll explain it to you. Histogram bars above the red line show extreme call buying. And you can see on this run off of the March lows how dominant the call buying has been at extreme levels. This has been well documented, all over the place, how low the put to call ratio has been. And this inverts it, so the call buying is shown being higher. And you can see here, even on this drop, our most recent drop, we never even saw any fear at all. I mean, we had, it just backed off the call buying, and after one day, they popped it right back up again, back into extreme territory, and only Friday did it back off back into this more or less neutral zone. Now, I'm gonna go into annotation mode here. This stock charts program is a little clunky at times. So the extreme put buying is when the histogram bars are below this lime green line. This measure, this chart, is very, very good at nailing lows. Here, you can see the extreme put buying cluster into the teeth of the March drop. Way down here. Tons of people piling into puts just as price was reversing. This was marked a low here. Capitulation low. This is back in the summer of last year. If you recall, we were going up or down 3% a day with the trade wars. We had quite a bit of chop in that area, but the meter actually detected these lows that aligned really well with the lows in price. And if we go back in time, here was the December Q4 2018 low, nailed the bottom. So here's my point in the whole thing. I have a lot of confidence in this measure of nailing lows. I don't think we can have a durable low with people buying calls. I want to see a capitulation low with some fear, to give us a day or two where people are piling into puts, desperate to buy puts, and that would be a place where I think I could confidently go long against that extreme put buying. And I just don't think. See, people right here, they're wanting to buy the dip. We've broken trend, no fear, I'm buying the dip. And this is just this week. This is, Wednesday and Thursday. Extreme call buying. I don't buy that. I think those people are going to get run over. That's my thesis. Now, does that mean I'm balls deep short? No. I interpret this right now as a potential inflection point. Not guaranteed by any means. So, I am short a couple of positions, but I'm not staking my life on it. I want to see the 50 go, and then you may see a gonzo moment where put buying in size makes sense. Because I think, like I said, once that 50 goes, if it does go, then there may be an opportunity for a flush slash panic moment where put buying or call selling would make sense. And if this turns out to be a buy the dip moment, I'm happy to buy at higher prices. I don't need to nail the low. I would rather be safe than sorry. And my posture now is people that are trying to step in long are jumping the gun, because I want to see how this stuff resolves. And with all the broken trend lines and with price doing things that it hasn't done since March, I think it deserves respect. I think it deserves attention, and I think it deserves caution. And I'll leave it at that with you. I'm going to try and put together maybe another video or two between today and tomorrow to show you where some strengths, some pockets of strength exist, because they are out there. This is a tech-driven sell-off, but the problem is that tech sentiment can hang over the entire market, because if tech is going down, those top 5 or 6 or 7 stocks are going to really weigh on SPY as well. You're not going to get SPY going up and the Qs selling off. It's just not going to happen. So, but we can identify sectors and industry groups that are performing well on a relative basis, and I want to try and point some of those out for you guys. Okay, I really appreciate you spending some time with me on a Sunday afternoon with NFL football kicking off. So, this has been Chris Buss with Trader's Profit Compass. If you like the content, hit the like button and subscribe. I'd love to have you join our group. You'll find links in the show notes to the blog and where to register for all my content, so you'll get it directly in your inbox each and every day. Thank you for listening, and talk to you next.